The market is finally starting to see some follow-through moves in the upward direction, and the daily trend is well underway of reversing. The key question now becomes, was this just an end-of-quarter window dressing type move that's just smoke and mirrors? Or is it the start of a larger recovery effort across the broad market? That's what we'll explore today in the Weekly Watchlist video. Quick reminder that the cash markets are closed on Friday in observance of Good Friday, but there will be an abbreviated futures session. As always, check out the links listed down below in the description, hit the thumbs up and subscribe buttons, and stay tuned until the very end of today's show. I've got 3 additional trade ideas to share with you that you're not going to want to miss. With that said, let's dive right into the charts. So kicking things off on the SPY monthly timeframe, talking about candle structure and location as we always do when a month closes. So for March, we've definitely got a green-bodied hammer candle. We know that in the lower wick, buyers stepped up, pushed prices to the opening print, and because we've got a green-bodied close, we go through the opening print for an extremely strong close at the top of the monthly range. That does strike me as being structurally much more bullish than bearish, especially combined with the fact that we break underneath an inverted hammer low and don't really see any follow-through in the downward direction. Now, let's not get it twisted on the location front. We did technically produce a bar-to-bar lower high as well as lower low, so not a ton of progress was made in the upward direction, but obviously what we're looking at here is the lack of follow-through from the sellers underneath the low of the inverted hammer from the previous month's close. I would also point out that from a structural pattern perspective, we are still dealing with an inverted head and shoulders, and if we can clear this neckline roughly between 410, 413, this general zone, we would look for more bullish outcomes on the monthly time frame chart. I don't want you to forget that yes, in the short term here, things have been very choppy. Obviously on daily time frame charts, it's been madness, but in the grand scheme of things, if we zoom out on the monthly time frame and take out the Fibonacci's from the sickness low all the way on up to the all-time high, this right shoulder and this chop is building out above the 38.2 Fibonacci retracement, which is of course more bullish than bearish. Obviously, we made a stand at the monthly 50 SMA. We are above the pre-sickness highs. It's very difficult to say bearish things about this pattern when we're looking at it from like a 90,000 foot view. Let's go ahead and take a look at the weekly time frame chart and see what other nuances we can observe from this perspective. So structurally, we are dealing with a solid green-bodied bar, very minimal lower wick there. If anything, it just implies that any selling pressure was met with strong buy-side reactions, and we of course have closed at the top of the weekly range. That structurally, of course, is more bullish than bearish. On the location front, we've produced on the bar-to-bar higher high as well as higher low, which is also bullish, of course. And if we think about where we're at, we have recaptured the weekly 50 SMA, that's the blue moving average. We are technically back above the support trend line as of the close here, and we're also above the resistance trend line, which we've known to be the case for a couple of weeks now. These trend lines are losing their importance. We probably won't follow up with them in the future. If we take out the Fibonacci's on the weekly time frame chart from the low up to the high, you'll notice that we're firmly now above the 38.2. Once again, this is the bullish zone in the Fibonacci bands. In previous weeks, we had been very close to the 38.2, and now we have firmly resolved that in the upward direction. Again, a bullish data point here. If we take that off and throw on our anchored VWAPs from the weekly perspective, we want the all-time high in the October low. We have closed above the anchored VWAP band. Once again, this is a big bullish step in the upward direction. Now, it's not firmly resolved the band as we have the 38.2, but it's a first step, right? Obviously, you have to start somewhere when improvements are being made. If we think about the structurally significant area on the weekly time frame chart here at 390, previous support, resistance in the upper wick here, and here, we know that we've been really focused on 390. Obviously, we're resolving this in the upward direction as well, which does strike me as a bullish data point. If we throw on our high volume node, which comes from the volume profile, we've made the adjustment and we have fully acknowledged that yes, it has moved higher to 395, but are we resolving that higher or lower? Obviously, the answer is higher and in the upward direction. We are in the low volume void, and the target should become the next overhead high volume node, which brings us up to the equal swing high here and just shy of 420 on the weekly time frame chart. Now, we've talked about some pretty bullish implications on these higher timeframes, but let's not forget, as day-to-day traders, are we really experiencing any weekly trend in this box here? Not really. Things will become much more meaningful when and if we can poke above this swing high at 420. That's where we look for those more optimistic outcomes from the inverted head and shoulders neckline break on the monthly time frame chart. There's still technically the threat that we could produce a weekly head and shoulders pattern here, but with this higher high being produced on the daily time frame chart specifically from from here to here, I'm not necessarily convinced that this is the most likely path forward. It's not off the table, but it doesn't seem as likely at this point in time. So overall, still in a neutral trend. If we isolate the price action to this box right here, of course, we're dealing with lows, higher lows, and the objective is the equal high, if not higher high, to still confirm the isolated and recent weekly uptrend. The expected move is always up first on the daily time frame chart. If you're not familiar with this study, top right hand corner's got you covered with a brief tutorial. Overall, if we're contained by the upper edge of the expected move here, the number is 415.56, and that of course would imply a higher high being produced. If we're contained by the lower edge of the weekly expected move, the number is 403.16. That also is a higher low suggestion from a daily trend perspective. That does strike me as being a bullish piece of information. Add on top of that the higher low suggestion is also above the previous balance range underneath us. Once again, expected move clearly favors the bulls in the coming week's worth of trade. As we mentioned in the intro, the daily trend is in the process of reversing. We were talking about a daily downtrend with highs, lower highs, lower highs, lower highs. We produced an equal high on the Wednesday session. We talked about this in the midweek market update. All that was required to neutralize the daily trend was a higher high being produced. We have that as of Friday's close. The next step is finding a higher low. And as soon as we find a higher low and start to reverse off of something, I'm drawing 401 because that's the ideal location, we can start to confirm a new daily uptrend. Now, as we just alluded to, 401 is the area of pullback that we want to see hold. Why is that? Well, in the past, we described the market as a tale of two ranges, range 1 and range 2, and together they formed a balance area. Obviously, we've broken out above that, and the top of this range is, as we know, 401. So pulling back, finding a higher low above that would strike me as a break, retest, and go type pattern, which is constructive and bullish in the upward direction. What else is providing super support around that area? We've also got our daily 50 SMA. That's the blue moving average on your screen. And if we take out our Fibonacci's, we can make a couple of more bullish observations. If we come in from the high down to the low, is the downdraft over? It's not technically over all the way, but we are above the 61.8 Fibonacci, which, as always, the more daily closes that we get above this area dramatically increase the odds of a 100% retracement. That does strike me as being more bullish than bearish. If we take out the fibs from the low of this move up to the high, let's say that we immediately pivot on the Monday session and we start a pullback, notice that 401 is clearly above your 38.2 bull flag consolidation zone. So once again, 401 strikes me as a very reasonable area for a higher low to be produced at this point in time. Another bullish observation is taking out our anchored VWAPs from the bottom from October, right? That's back here. All of our pivots have been added. We've added in the low here now that we've started to reverse the daily trend with the higher high. That's the yellow one. Obviously, it's lower in the VWAP pack down here, but clearly we're above the anchored VWAP cluster, which does strike me as a bullish data point. Recall that the quote-unquote average buyer now, who's been involved since the October low, has incentive to add to the position and not close the position. If we're underneath and they are underwater, that is obviously a much different story. So anchored VWAP here does strike me as being more bullish than bearish. Quick comment about overhead resistance. We are running into this overhead supply, and on Friday we ran right into, keep in mind, extended through the upper edge of the weekly expected move, we ran into the bottom end of this prior balance. So is 408.75 a reasonable area for a pullback to unfold from? Absolutely, and coming off of a higher high, it's very reasonable that the market can afford a higher low pullback. Let's take a look at the hourly time frame chart and see what's going on from this perspective. You'll recall that in the past we've been talking about an hourly uptrend, and that's still very much so the case, but I want to point out that we are through or possibly extended at the upper bound of the upward channel. And again, does this coincide for continuation in the upward direction, or does it start to suggest more of a pullback is around the corner? I don't know about you, but I would certainly be open to the idea of a pullback off the upper end of a trending channel. Now, let's talk about some psychology. Obviously, the market experienced many gaps in the upward direction in the later stages of the week. Even on Monday, we had the gap fill reversal, right? Not indicative of new money sellers. This gap, partial gap close, I should say, and then rally into the close on Wednesday. No new money sellers there. Full gap fill reversal. Again, if big new money sellers are going to enter this market, they're not going to stop at a prior high of day. They're going to drive this thing into the ground. They're going to get short, and the markets will move lower. Because we're reversing off of these very nuanced areas, you can say that short-term sellers, sure, they made a stand here, and we potentially had some longs in the overnight session closing out with poor location, but big new money sellers are not getting active. We'll also see that in the market internals in just a second. This is also not a short squeeze. This is not short. Well, it could be be some bit of short squeeze, but there are also new money buyers stepping up. And again, we'll show you that in the internals in just a second. So let's finish it up as we always do with a couple of scenarios. Obviously, the most bullish scenario is that we just get straight up continuation into 413.25 and then the upper edge of the weekly expected move, which would be a double of the daily balance range. Recall, again, that when we break out of a balance range, we look to double that range, and that takes us much closer to the top from in here, 416.75. That is asking a lot of the buyers at this point in time. As we've sort of alluded to, it's very reasonable that the market could see a pullback off the bottom end of this balance, rejecting here, right, at 408.75. And the idea is that we look for support first at 404.50. If it doesn't hold, it's not the end of the world. The do or die level is 401, as we've just pointed out. The bears really have a lot of work to do if they're going to make a stand here and clearly reverse the market back in the downward direction. It's got to be a lower high underneath 401, which, as you could imagine, would require quite a lot of selling pressure. Then the gap fill is in play. Notice that this is far underneath the lower edge of the weekly expected move. I'm not sure that in a shortened holiday week, that'll be the first and primary objective of the market. I think the primary objective is either sideways consolidation above 401, a pullback to 401, and then a reversal, or very, very minor continuation in the upward direction. Those would be the situations that I favor into the coming week's worth of trade. Market internals are up first. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. In the volume quadrant, obviously we made significant reads on the daily reads themselves on Monday, Wednesday, as well as Friday. Tuesday and Thursday were also bullish, but just not to the same degree. And obviously on the weekly cumulative net inflow, we're well above 1 billion, right? We're reading at 1.2 billion, very significant volume inflows. Again, this is much more indicative of new money buying, not just short squeeze in the last week's worth of trade. The same thing could be said about the advanced decline line. Almost all of the days had some interaction with the trend zone higher, barring the Tuesday session here, which did technically find support off of the zero line towards that end of day rally. So not really new money sellers getting aggressive on Tuesday. It was just digestion of the move. So overall, 2 for 2 so far on the bull side of the market, and 3 for 3 if we take a look at the ticks. Notice that the cumulative builds here, here, and here are sustained throughout the day. It's not like we have something that goes like this, straight higher and then flat and possibly down into the afternoon. This is what happens when you see a short squeeze. This sustained buying pressure on Monday, Wednesday, and even Friday does strike me as new money buyers getting active, and we're not concerned with big new money sellers entering the market. There's no evidence of that on the Tuesday and Thursday sessions where we threaten a move underneath the zero line or just very neutral in general. So to sum it up, new money buyers seem to be here. New money sellers not in the picture. This is not just a short squeeze. This does support more of the bull case and not just a window dressing scenario into the quarter close. Here's the market profile. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. I know this looks kind of funky, but that's what happens when you travel such significant range in a short period of time. If we think about the nuance of how this move higher has unfolded, let's say that the bottom was on the Tuesday session. Here's value. Wednesday value is higher, point of control is higher. Thursday value is higher, point of control is higher. Friday value is higher, point of control is higher. All of these value areas are breakaway to the upside. None of them are overlapping. That does strike me as being a very bullish indication. Now, on the Friday session, technically individualized, if we're only looking at this session, yes, we did not shift value higher in that day's session, and the point of control is much more towards the midpoint of the range. Is that telling us that we're getting a bit overextended towards the top of this move? It's potentially a sort of idea that the profile is suggesting, and it wouldn't be unreasonable for a pullback. We've drawn a very similar conclusion on the SPY daily time frame chart, the hourly time frame chart. I would also point out that we have 5 VPOCs, virgin point of controls, that have not been tested underneath us. So as we start to get, really it's more than like 3 or 4, it's totally reasonable that the market comes in a little bit, tests one of those points of controls, and then pushes away in the upward direction. So overall, this would suggest that, hey, a pullback could be around the corner. The market might be getting a little bit ahead of itself with value not shifting higher with price on the Friday session. Be open to a pullback, but overall the market structure underneath us is constructive with new money buyers committing volume at higher prices. Moving back on over to the platform, let's have a look at the performance of our weekly sectors here. Notice that the XLE leads the pack up 5.23%, not really ideal, noting it's a lighter weight risk off type sector. It's followed by discretionary and then real estate. At the bottom of the barrel, we see the healthcare sector, financial sector, as well as consumer staples. So overall positioning, kind of a mixed bag. The tech sector is in the midpoint of this distribution, still up a solid 3.3. I mean, obviously when everything's green out there, it's pretty difficult to say that anything is really bearish. in the first place. Let's take a look at these structural charts and evaluate what's going on from a trend perspective. The XLE energy sector is backtesting the top range here, and as we pointed out in previous videos, I would love to see it just back off a little bit and go sideways, and the slack to be picked up in the heavier weight risk on type sectors here, as well as here in discretionary. So far so good. Really just don't want to see this massive breakout continue and threaten a move over 87.50. Not concerned with energy as it stands right now. XLY, extremely impressed with the price action here, specifically on the Friday session, producing a big new higher high if the levels would load. There we go, above some of our previous structure, namely in this zone here around 146.50, 147. Because we've produced this higher high, you can start to look at this as an inverted head and shoulders, and of course, the daily downtrend is no longer. We're waiting for that higher low pullback. Ideally, it's just anywhere above the neckline of that pattern. Once again, right around 146.60, 147, this general area, as long as a pullback or just price consolidation happens above that, this to me is a big step in the right direction for more of a risk-on look in this marketplace. As long as this picks up the slack as energy pulls back and some of the other lighter weight risk-off sectors pull back, really pleased with the improvement here in the XLY. Worth paying attention to heavier weight risk-on sector. Let's keep it a bit briefer in something like real estate, which is a lighter weight, neutral, sort of defensive-esque type sector. It's in the neutral box. It's not producing continuous pressure in the downside. Obviously, with rates falling down on the Friday session, a nice day of outperformance here, but nothing impressive is really happening. If anything, it has a positive impact on the wealth effect, and we'll leave it at that. Next up, we've got XLB for materials. What's going on in the materials sector? Really lightweight sector. It's not going to pull your S&P too much. It's inside of the balance. We can say that this is neutral. If anything, it's providing slight bullish pressure for the S&Ps, but it's not really going to be a force to reckon with until it can produce a swing higher high or a swing lower low. So in the neutral box, kind of just treating it as exactly that, neutral. Next up, XLI, very similar from a structure perspective. Obviously, you've got a range here. This is a heavier weight sector as compared to the XLB materials. This is more like 8% versus the, I believe it's like 2.3, 2.7, something like that in materials. So much heavier weight for the S&P. Obviously, this trend here is more meaningful thus. So watching for bullish pressure here out of this sector as we get more acceptance in this upper range as of the close on the Friday session. Even if we pull back again, we can see a constructive higher low above the double bottom neckline, which would be 98.70. So no issues in industrials. XLK, another sector with just dramatic outperformance throughout the really the Friday session and structurally getting a big new higher high above and outside of the previous range from here. So although it's not at the top of the list, I mean, structurally speaking, the trend here is really solid and sound. We have good, lows underneath us, higher lows, nothing really jeopardizing a new daily downtrend with a higher high, as we've talked about and as the theme of the video has been thus far. We can clearly afford a higher low pullback. Ideally, that higher low pullback is above 147.85, not the end of the world if we have to come in for a retest of 144. Straight up continuation, I would start to think that this is getting a bit frothy and overdue for a pullback. I'm not sure I would want to participate at those higher highs. Next up, we've got the XLU. What's going on in utilities? Again, a D for defensive type sector. Structurally, it's not outperforming. Percentage-wise, it's looking okay. Again, everything was green here, but as long as it goes sideways in sort of this box, as long as it's not doing anything dramatic to threaten a new pivot high over 73, no concerns yet out of utilities. Communications, this is another really important higher high that was produced in the past week's worth of trade. Notice that we have a daily bull flag breaking out into the Friday session, recapturing the breakdown point from here above 57.30. Everything about this strikes me as constructive and starting to point more towards risk on as opposed to risk off. Even if we do get a pullback again, we can afford a higher low at this point in time. Really don't want to come all the way back down to 55 after this period of consolidation. I would say that the top of this range is probably, you want to see sideways consolidation, maybe a minor sweep of those lows, and then something like this. I wouldn't call it a line in the sand yet, but certainly 56.50s would be more constructive on the higher low. Next up, we've got the XLP staples sector. This is a slight cause for concern. I'll always give credit where credit is due because this is a D for defensive risk off type sector. The fact that it's broken out so firmly after this massive congestion period strikes me as a slight cause for concern. Again, why? Because as we know, staples typically outperform in the recessionary type theme. And if this starts to outperform, what is that suggesting about where the economy's headed? Again, we have to deal with the price action in front of us. And so far, everything's constructive in the S&P. But in the grand scheme of things, if this continues to outperform and we do not see follow through out of tech, out of something like discretionary, and even our financial system sort of rebooting, if you will, then it's not the best look. So keeping a very close eye on this. I'll always concede when there is a bearish data point, and this is one of them. Of course, the XLF is another one of these slightly bearish data points. It did technically produce a higher high from here to here, but it's still in the bear flag consolidation. So we are not out of the woods by any stretch of the imagination in the XLF, and being a really heavyweight risk on type sector, it's just, it's very difficult to have a full-blown confident look in the market with the struggle still here in financials. So don't get me wrong, great improvements out of tech, discretionary, even communications, as we just discussed. But this really has to break the top of the flag range and get going through this thin structure, retracing that thin structure before I'm a bit more confident, full scope about the market's state of affairs, so to speak, for a lack of a better term. Next up, we've got the XLV healthcare sector last, but certainly not least. Again, this is the second heaviest weighted sector, so it does have to participate in upside rallies or at least not be moving lower, and it has done so, right? It's been going sideways off the low end of the monthly balance here. It's threatening a break of a very ugly and sloppy, but it is there, inverted head and shoulders up and over 129.50. That's the level we've been tracking for some time. If it does break, I mean, this has just been such a slow grind lower. I would not feel comfortable trying to pick out levels in that area. I would just be mindful that, the midpoint-ish of that range prior structure from here, 133.50, could act as a magnet. And also from a measured move perspective, it's roughly aligned with where we could potentially go. This, of course, would be bullish pressure for the S&P, but just like the XLP consumer staples, does have much more of a recessionary theme to it if it starts to outperform. Here is the sector ratio grid video tutorial in the top right-hand corner if you're not familiar with it. Overall, the top 4 risk-on sectors, they're looking kind of mixed at this point. Obviously, the XLK continues to be the glue that holds the risk-on look together. The XLY perking up here in that big break over 148 that we just discussed on the structural chart does strike me as an improvement as well to the risk-on half here, but XLV kind of just struggling at these lows. Obviously, we talked about weakness in financials. It's not a full-blown risk-on look, but the XLK is the most promising of what we have on the screen in front of us. XLC, probably the most closely related to tech as a whole, which is also outperforming here above an upward sloping 50 SMA. The bottom 4 are the risk off sectors, of course, and how do they look? Really sideways, not threatening a big jump in the upward direction. Same thing could be said about utilities, although this structural chart, as we just alluded to, is not the best looking, right? Energy is still underneath a downward sloping 50 SMA, and real estate is just finding a little bit of a counter trend rally under big distance underneath a 50 SMA. So risk off is also not fully there. Obviously, we're just waiting for more of a recovery in the financial sector. If that is going to happen, obviously more of a risk on look is going to overwhelm the market. If we take a look at XLY over XLP, so growth versus value, we've got growth and value. It did make a stand at our gray bar, the previous double bottom from in here, and then lower highs before that final flush lower for the end of 2022. So the fact that this is trying to produce a little bit of a double bottom type look does strike me as constructive. If we can clear that neckline here, that of course would speak to more risk on favor in the market. How's our good friend the dollar doing? It's still consolidating underneath that 103.50 area, which does strike me as bearish consolidation underneath this previous area of congestion here. That of course would typically imply bullish outcomes for the equities market down below. Again, we're being very flexible with this relationship right now with the banking crisis trying to resolve. If we take a look at the gold contract, that's /GC, it just remains in like a picture perfect textbook bull pennant pattern up here, which does of course suggest upside continuation, which in theory would put pressure on the dollar, which then of course drives equities higher. So overall, this relationship does still look bullish for equities as a whole. And if we take a look at what rates are doing as well, rates are moving lower, as we alluded to in the XLRE real estate segment there on Friday, a big drive lower. What I also want to point out, which is really, really noteworthy here, is that rate volatility. Look at the volatility here. Look at how it's settled down in the last week's worth of trade. You really want to see interest rates settle down from a volatility perspective if you're going to have cleaner moves develop in the market. And so far in the last week's worth of trade, we have seen them cool off just a little bit. We're not seeing massive swings up, down, up, down, up, down. Now, granted, we're still in this box. I would say that we are dealing with technically bear flag consolidation at a known flush point here around 3.4. If this gets back down underneath, technically that should have bullish implications for our markets as pressure is relieved from the tech sector. Speaking of rates, there's still about a 50-50 shot for a pause or a 25 basis point hike in the next meeting from the Fed, which by the way is May 3rd. And if we take a look at the back half of 2023, notice that we are holding those rates higher and then cutting later than originally forecasted when the banking crisis was in full swing. So the market's anticipating that inflation is coming down, rates can be sustained at these higher levels, especially if we think about what happened with PCE in the last week's worth of trade. If we go on over to our calendar here, this this is the coming week's worth of trade, and the main thing that we have to focus on is really the NFP on Friday. Ironically, the market is closed then, but we'll probably do a live stream and just, see what the numbers are that morning. But if we go back to the previous week, we know that PCE came in underneath the expectation at 0.3. And it's really noteworthy that services inflation actually showed a big downtick in the PCE reading, which is exactly what the Fed wanted to see to sort of confirm that, yes, our battle against inflation is so far becoming successful, right? The typical saying is that you need the Fed funds rate to be above the PCE inflation rate, which is 4.6 on a annualized reading, right? It just came in at 4.6. The Fed rates currently is above that, right? Obviously, we know if we go to the current rate, we are sitting between 475 and 500. Now, as I was just talking about, sorry for all these jumps, but if we go into the coming week's worth of trade, Friday, it's all about unemployment, right? Because what's the consequence of potentially higher rates? Well, it's unemployment. And if that starts to spiral out of control, that's where we start to fear more of the recession. Now, what I want to point out is back on Thinkorswim, we can track the unemployment rate. And if we throw a 12-month moving average on this, right? This is a monthly chart. We're tracking a 12 SMA. It's basically looking at the yearly average, right? Look at how in the past, let me actually scrunch this back up. As we start to tick above the 12 SMA, things start to become a little bit more concerning in the markets, right? So I'm not saying that this will happen this way. It must immediately mean that the market's going to flush here on a move above the 12 SMA, but it's a consideration for this upcoming Friday's release. If people start losing their jobs in more of a significant fashion, what are the implications for corporate earnings as we move forward? Again, this does not have anything to do with what we should do on the Monday session. We should be thinking about all the technical data that we just walked through, but this is something to have from a narrative perspective in the back of your mind if you're a longer term investor. The market is also regaining some risk appetite. You can see that the relative strength from the TLT is starting to deteriorate ever so slightly. It just means that the risk off flight to safety type trade is no longer at the forefront of the market's mind. Now, this could very easily come back up into the box, but something that really counters this narrative here, and which I really love to see, is actually the HYG junk bonds breaking out in sync with the S&P 500. We had talked about in the past this range as being the equivalent of like kind of keeping us sane in this area here, right? It was saying, hey, higher high, don't get so greedy just yet. Lower low, don't panic just yet. No lower low in the HYG. Now that it's breaking out and moving in sync with the S&P equities above this most recent local high, that does strike me as a confirmation signal that overall this move is, again, not just window dressing for the end of the quarter. We are seeing some true risk on implications from the underpinnings of our market. And even if we take it one step further, I know this is a bit of a stretch, but look at what's going on with Bitcoin and the crypto market, right? We of course know, and I'll continue to say this almost every single time so nobody misunderstands what I'm saying, this is not a one-to-one correlation with the equities market, but from a risk appetite perspective, notice that we're just digesting this big recapture after the breakdown back underneath the breakdown bar high. To me, the fact that this consolidation is high and tight would speak to bullish risk-taking environments being more so the tone as opposed to risk off, sell everything, we've got to cover the bills, like our mortgage, like food, like this, that, the other thing. Risk on appetite seems to be, right now, across everything we've seen, more so the favor as opposed to risk off, run for the hills. And even as we look at market breadth indications, notice that new highs versus lows has snapped right back up to the zero line. Don't get me wrong, it still can morph into a look like 2022. You can see a number of times where we went to the zero line just to back away, to the zero line just to back away. I'm not saying it can't deteriorate, but so far, as long as we've improved off of these lows, it does strike me as being a step in the right direction. If we take a look at stocks trading above their 200 SMA in the S&P 500, there's also been a sharp recovery to the 50% mark and above even in the past week's worth of trade. So once again, a step of improvement here. We're not out of the woods, but it is a step of improvement. We're no longer really threatening that bearish look where underneath with a lower high, all of a sudden you start to become concerned with a test down here at the lows and big deterioration across the market. Another one that we've been really concerned with is the 50 SMA, stocks trading above their 50 SMA in the S&P. We've been saying that, hey, even as this market has been bouncing back in the upward direction, we haven't really seen follow through, and it's still just a counter trend rally until proven otherwise. This is a daily time frame chart. This, of course, represents the big move on Friday. It would suggest that across the entire S&P 500, on Friday specifically, a lot of companies have just recaptured their 50 SMA. Again, that has to strike me as being a more bullish than bearish data point. If we were going to reject underneath 50 SMAs, this would not have perked up here, and I suppose we will continue to monitor this going forward. If instantly next week everything loses the 50 SMA, that will be reflected here with a sharp push back down into this range. So we'll keep you posted on this chart, but so far so good with the move back into the 50% mark. Let's take a look at our equal weight S&P 500. This, of course, is the RSP up top, and we have pushed firmly away from the December low after diverging compared to the regular weighted S&P here. We also talked about the divergence happening here with the lower low versus the higher low in the S&P, speaking to only a few good apples keeping the S&P afloat. With this big recovery, with taking out the top of this range, I would say that we're moving much more closely to being in sync and not as concerned with a breadth divergence at this point in time. Obviously, the next big concern would be if the S&P can take out this high up here, where is the RSP in relationship to 155? We'll keep you posted on that relationship as it unfolds. Next up, we'll take a final look at the Dow divergence, see what's going on with this chart, syncing back up as we talked about in previous videos. It was all about this ascending triangle putting us back into this range, which starts to sync back up with the location of where we're at here. Still higher in the transport range as we are in the industrials range, but once again, as these things start to move closer to lockstep, it means that we are confirming better moves across the market. And finally, some volatility analysis. Note that we are still underneath 2050 as we were from the close on the Wednesday and Tuesday sessions here. So that does strike me as a signal of comfort from the market that this low can hold as being secure thus far. It is not a guarantee, but once again, from a vol perspective, nobody's really prepared for a massive flush in the downward direction. If people were truly skeptical about the window dressing, I think you would have seen this remain elevated above 2050 if there were truly, again, systemic underlying risks that were just going to blow the market up as we move forward throughout time. And the same thing can be seen in the VVIX, volatility of the volatility index. This is suggesting that nobody is overly concerned with being hedged at this point in time. And because we're coming off of a time frame where everybody was starting to become panicked, we're not yet at the point of complacency. Really requires getting down to 75, sideways around 75 for some time like what we had in here for that complacency effect to start to build. So not overly concerned with that at this point in time. If we take a look at volatility futures, just to check in on backwardation versus contango, we are firmly in a contango. There's no arguing with that. We're well underneath the zero mark here, continuing to fall off of a cliff in this relationship, and even 9-day versus 30-day VIX, which I know that up top, this registers 30-day options and greater. This, of course, registers things up to 9 days, right? So as this falls underneath the zero line, even in the short term, there's not this big volatility spike where we're in backwardation. So overall, really liking what we're seeing from a volatility perspective. Folks are fairly comfortable with this acting as a big weekly higher low. Let's take some time here on the QQQ and do almost a very similar analysis to what we just did in the S&Ps. On the monthly time frame chart, we are looking at a bullish engulfer. We looked underneath the inverted hammer low, did not find any acceptance, but the big difference here, obviously, is that we did produce a higher high on the monthly time frame chart. We don't as cleanly have a inverted head and shoulders type pattern. You could make the argument that this is a very minor right shoulder, and we're already starting to break the neckline, but I would just more meaningfully say that we've made a stand at the monthly 50 SMA, and if we take out the fibs from low of the move to the high, we know we've experienced more of a drawdown in the QQQ, but we did technically support at the 61.8 on the monthly, and as of last week's close, we're back above the 38.2, so big progress has been made here in the upward direction, and obviously just from a trend perspective on the monthly, right, if you isolate this box, this represents the same congestion that we're experiencing in the S&P. We've resolved that higher in the QQQ, which does strike me as clearly a more bullish than bearish implication, gobbling up that inverted hammer. Here's the weekly time frame chart of the QQQ. In the past, we had been concerned about this as a double bottom and holding on to the neckline. We've firmly pushed away from that. We're above the 50, we're above the 200. If we come in from the Fibonacci's of the low of the move here up to the most recent high, a reasonable pullback, the 38.2, still keeps us above the neckline of that weekly double bottom pattern, which does strike me as being noteworthy. Let's move on down to a daily time frame chart, and we'll throw our drawing set on here and walk through expected move, all that good stuff. What's going on? So expected move is, of course, bullish. Big higher high, higher low, well above the top of this previous range. Even if we poke into the prior range here, I would say it's not the end of the world. 311.75 is really the key level from here where the breakout really began from. That, to me, would strike me as the most optimistic and bullish of pullbacks if we move lower in the first place. Straight up continuation, your overhead target is 328, not suggesting at all that we move to 333.75, but that is the next structural element. If we fail back into this range, let's call a spade, right? Technically, this would be a look above and fail. The next line in the sand, no ifs, ands, or buts about it, would be 307.50 on your QQQ to provide a daily higher low. If we take out the Fibonacci's on this particular chart from the low of the move up to the high, and we're going to zoom in on this ever so slightly. Oops, let's do that. There we go. We can see that, again, look at that number. Boom, right here. 38.2 is your 307.50 roughly for all intents and purposes. So look above and fail. Even if it does take us to the bottom end of the range, it is above the 38.2 from this perspective. Let's throw on our anchored VWAPs and see what's going on from this perspective. Clearly above all of them. We know where all those anchor points are coming from. Here's the one from the most recent local low. I mean, very, very bullish. We're above all of that. We know that there has been relative strength in the tech sector. Is it reasonable that after a daily higher low, we can produce a higher low pullback? Absolutely. I would not be concerned with early on in this coming week's worth of trade if a pullback starts to develop. You have the levels, you have the structure underneath us, everything's sort of making sense here. We can take a look at the NASDAQ internals. So we have the S&P internals, we have the NASDAQ internals. What do we see here, right? Certainly not as significant in the volume inflows on Monday. We even go a bit bearish on the Tuesday session, get significant on Wednesday and Friday, and this is not even close to $1 billion in terms of inflows. It's not as strong. This move over the past week's worth of trade has not been as strong as the S&P, but that shouldn't really be much of a surprise because the NQ has really outperformed previously compared to the S&P, right? So the NQ has already done the work. We don't need that added strength to really be an indication of a better reversal out of the NQ. That's what the volume read would tell me at least. Same thing here in the advanced decline line, never really spending any time up above in the trend zone. And the ticks, they're kind of a mixed bag here, but overall price action pointing higher. On the Tuesday session, it is a significant bear read in the cumulative tick. I will give credit where credit is due, but notice how, again, think about psychology here, no gap fill on the Wednesday session, and then a sustained bullish read into the close. So who's really the one showing strength? The bears trying to make a stand here, or the bulls who held the gap higher, continued to rally it into the close, and then saw follow through into the end of the week? I don't know about you, but again, everything that we're seeing on the screen in front of us would align more closely with big, or maybe I shouldn't even say big, but just new money buyers continuing to prop the trend higher in the QQQ and the NASDAQ 100. Let's take a look lastly at the market profile for the NQ, and what we'll point out in this is very similar to the ES. There's not a whole lot to describe that's different, but if this is the bottom, there's value. Here's value higher, value's higher. Everything's basically the same in the midpoint of the Friday range on an isolated perspective, with the point of control being more middled instead of closing at the highs. So once again, is it reasonable that the QQQ experiences a pullback? Absolutely, and we can start to look for some of those downside levels that we just talked about on Thinkorswim. Speaking of Thinkorswim, let's go back on over here and finish up the broad market with the IWM. We get the idea. Let's just leave these anchored VWAPs on for just a moment here. We're not going to do monthly, weekly, and IWM, but we're underneath the major cluster. This is just chopping around sideways down here. There's a lot of work to do in the IWM. That should not come as much of a surprise whatsoever. We know that this does act as a risk on versus risk off. Twisting words here. Risk on versus risk off gauge, and because it is exhibiting some weakness, I think it's a reason to believe that, hey, as long as the QQQ and the SPY are still in an uptrend, that's fine, but buying on new higher highs, I'm not totally convinced, right? We want to get involved in uptrends on the higher low pullback for then the reversal back up to the equal high and potentially follow through the equal high break to then form the next higher high. And the IWM staying down here in this zone. Don't get me wrong, it started to break on the Friday session, but staying down here relative to the VWAP band, relative to this breakdown, relative to this previous balance, I'm not just convinced that the market's ready to flourish and recover. It's making strides in the right direction. Let's be very clear. This is one data point in the web of analysis that we do. This is the analysis that we do. Every single little dot in here is just representing one data point. The IWM showing us relative weakness down here at these lows is perhaps maybe this data point right here. Weighed with all of the other evidence, it's not the only reason to just be bearish in every other big sector of the market. So as of right now, that's the in-depth analysis. Hopefully you appreciated the deeper look at the QQQ. If you did, let me know in the comment section so I can either continue to incorporate this level of analysis in the Qs or omit it going forward. I think there was some pretty positive feedback in the last time we did it. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that said, we'll dive right into Apple, leaving it zoomed out so you can see where this previous structure is coming from at 167 and 170.50 respectively. If we zoom into the current price action though, I want to point out that obviously this is a bullish chart. We have broken out of this balance range right here, and for all intents and purposes, we're coming up on the doubling of that range as we maneuver closer to 167. So I don't really think it's appropriate to be a big new money long here, expecting massive follow through. I'm not saying you can't continue to scalp it in the upward direction into 167, but swing traders, I'd be cautious about new money longs here. Instead, The more responsible trade, of course, is waiting for that pullback. Any higher low above the breakout point here, 161.25, very attractive in Apple for upside continuation, back to the equal high, and then follow through to those levels we were just describing. 170.50 is the next one. Obviously, 161.25 is very optimistic and like structurally perfect pullback. If it does go deeper, any higher lows that are mainly above 156.50, the top of this previous range in here, keep the chart constructive on the bull side in Apple. We'll reevaluate if it gets down underneath that balance high. Next up, we've got Netflix, which just continues to move against what I personally think was going to happen. But objectively speaking, we've got a daily bull flag breakout. We've moved above the 50 SMA. We have a gap and hold on the Thursday session, and we've closed above that Thursday high on the Friday session. So regardless of what I thought was going to happen, breaking down underneath these inverted hammer lows, the chart is suggesting bullish activity here. And we do have thin structure from the breakdown in this area. The target would be 355, and lo and behold, a measured move just based on a quick eyeball test from the bull flag breakout does take us directly into that area. So 355 in Netflix on the upside, all eyes on that level. If we do pull back, clearly buyers just want to see us remain above the top of the flag at 332.50. A lower high underneath would start to become constructive for a head and shoulders pattern where we'll start to reevaluate shorts when and if a neckline does develop. So keeping it very objective in Netflix. I've been wrong about that one as we've been moving through that price action. Next up, what do we have with Tesla? This is one that I'll rightly say or proudly say that we've been right on, right? Breaking out of the balance in the upward direction, really constructive on the hammers that we saw that were holding up above the top of this range from in here. It was just a patience play in terms of finding the day we were actually going to see follow through. It was Friday, right? So Friday up and over 200 trade was great. Looking for the top of that range to come into play at 213. That would be the full look below and fail, and we'll reevaluate when we get to 213 as well as that daily 200 SMA. So I think there's a little bit more follow through that can be discovered in Tesla in the upside. Anything that's above that 230 is the next structural element. If it just reverses off the top of the range, we'll treat it as choppy until the next break happens, which would be a firmer breakout back up and over 213 potentially after some consolidation. If the bears are really going to step in here, it's got to be a lower high underneath 200 for me to change my tone and then retarget the bottom end of the range with the strength from Friday. Not convinced yet that that is a likely scenario. Next up, Google. What's going on with Google? Higher low off of 100, so beautiful break, retest of this previous set of lows in here, looking for the equal high to come into play at 106.25. Follow through from there brings you up to 108 roughly, and then anything above that 110.75. So far, everything about this looks good for a continuation move in the upward direction, holding the 200 SMA, holding the strength of this rally in here, not giving back too much of the move, respecting a nice round number. Bullish on Google until proven otherwise. It would really require deterioration underneath 100 to flip back to the bear camp. Next up, we've got Metaverse. What's going on with Zuckerberg's fantasy land here? This is another one that we were fairly patient on and were rewarded with on the break up and over this area here. 207 did see some follow through on the upside swing from Friday. Looking for continuation. We know there's quite a ways to run until 221. So after a period of consolidation, this is just like day one of the break on Friday. Looking for the follow through move. Of course, you have to be responsible. You have to use a stop loss. We're not just saying that it's going to magically float here, no issues. If it does fall back down underneath 207, think about the trapped longs, right? The swing trade trapped longs. So we're like, oh goodness, here we go. Look above and fail. We'll call a spade a spade. We should technically retarget the bottom of the balance, the top of this range at 195.50. So staying objective there in Meta as well. Next up, NVIDIA. The chart that just will not back down by any stretch of the imagination. Bullish engulfer on the Friday session. Again, I am just too cautious and not interested in new money longs up here as we've exhibited, relative weakness in terms of momentum in the actual name. It did break to the upside. It is moving in the upward direction, but I would much prefer to show you a chart like ON. Let's go on over to ON and say like, hey, if you're going to play the semi space, I would not look at NVIDIA. Look at this. Like, look at that. To me, better risk reward. Stop can go right underneath. I get it. We've moved from the lows all the way to the highs. Maybe it requires a pullback first and then a break. But overall, the structure here is much more respectable, much more tradable than something like we have in NVIDIA at this point in time. And I get it. ON doesn't have the magic, badge of AI, but the structural chart does look fairly good as of right now. Next up, Microsoft. What's going on in Softy? Obviously, you can see a bull flag breakout has begun on the Friday session after a gap fill reversal from Thursday. Looking for 294 on the upswing. Higher lows just want to hold above 281.50 to remain constructive on the new breakout of the flag. Next up, we've got Amazon, last but not least, the mini beast. Then we'll move into those 3 trade ideas. What do we see here? Break of the balance range. If we're going to double that range, it should take us closer to like 105.50, just shy of 106 roughly. So watching for some more follow through out of this one. This is the laggard, or it has been at least, probably because it's not as involved in AI like Microsoft, NVIDIA, and even Meta to some extent, really. Tesla is just in a league of its own, of course, as is Apple. But overall, Amazon has been the laggard. If it is going to play catch up, this is easily a target, and then looking for that 108 and the 200 SMA on the upswing. Again, we will call a spade if we get a look above and fail, which doesn't look likely as of the strong close on Friday, but if we close underneath $100.75, retarget the bottom of the range at 96.50. Final reminder to hit the thumbs up button, subscribe button, all that good stuff YouTube tells us to tell you about. Let's dive right into ROKU. ROKU is the first trade idea here. A breakout over 66 is a pressure cooker top break. And the next structural target comes from here at 70, but is also a measured move rotation as well into that vicinity. If we do see follow through, the pivot and swing high here at 75.50 is on the table. Not interested if this never sees a break of 66 in the first place. Obviously, flushing these lows, maybe you're interested on the downside, but given the relative strength we've talked about in the market right now, I'm not convinced that I would be overly aggressive on that particular breakdown. Next up, we've got Coin. What's going on in Coinbase? Never thought I'd cover it again on the channel after the demise of crypto, but here we are. Look at what's unfolding. We have thin structure off to our left. Another pressure cooker top has formed here around this 66.75 area. If we can crack it, looking to close that gap overhead into 76.75. Fairly straightforward trade here on Coinbase, or at least the intention of the trade. Next up is BA. What's going on with Boeing? If the market does see a pullback, I think Boeing is a pullback candidate as well, considering we went wall to wall, bottom end of the range, straight to the top of the range, and we did print an inverted hammer on the Friday session. If we can get underneath that inverted hammer low, looking for a very minor intraday pullback into the 50 SMA on the daily time frame chart and 207.75. Perhaps the hourly chart does a better job of showing you where this structure is coming from, but we've got a really strong break. Sellers stepping up at the top of the weekly range, flushing these lows. I'll give you the number right now. Actually, 211.50s should bring you down to 207.75. Decent range to be trading for, especially with options being so liquid on something like BA. That's really going to wrap up today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving a simple thumbs up. We will be live on Monday at 8:30, and don't forget that Friday the cash market will be closed in observance of Good Friday. With that said, everybody, I wish you a green trading week.